Everyone, and welcome to our segment on Analyst Take Value Portfolio. So if you're joining us today, you would know that investing can often seem like a maze of strategies. Today, our focus will be on the concept of value and what value investing is about. So value investing is about identifying stocks that are trading below their intrinsic worth, offering a potential bargain for some discerning investors. Unlike growth investing, which targets companies with high potential for future growth, or index investing, which seeks to mirror the market's performance, value investing emphasizes finding fundamentally strong stocks that are undervalued by the market. This approach, championed by investors such as Warren Buffett, aims for long-term gains through the careful selection and patience of stocks. And joining me in this discussion today are two research analysts from the industry. We have Zheng Feng from DBS, and we also have Casey from CGS. Thanks for joining us, guys. All right, and when it comes to value investing, one of the common things that I always heard investors talk about is this thing called a value trap. So what is a value trap? A value trap is when an investor buys stocks because it appears undervalued based on traditional metrics like low price to earn ratio earnings or price to book ratios. However, the stocks remain cheap and usually for good reasons, such as fundamental problems with the company's business model, declining industry prospects, or some other reasons. These issues prevent the stock from appreciating in value, essentially trapping investors in a poor performing stock where the price don't rise, right? So a value trap basically looks like a bargain, but turns out to be a long-term loser. And what can we do to ensure we don't fall into such a value trap, even as we consider value investing? And helping us to answer this question will be Zheng Feng. Zheng Feng, I know you have some slides with you, so that maybe you can share with us your slides and explain to us how we can avoid falling to value traps.
Sure. Thanks for the introduction. Yeah, let me share my slides now. I hope everyone can see my slide.
Yep, it looks good.
Okay, so hope everyone can see my slides. So today I'll be talking about how to spot a value trap. Okay, maybe a bit of introduction about myself. My name is Zheng Feng, and I primarily cover the consumer sector at DBS. So maybe just a shameless plug before we start. So if you'd like to know more about the latest updates on our local coverage, please do subscribe to our Telegram platform. Right. So before we start, I actually requested Share Investor to put out this poll showing two financial metrics for company A and company B to let you guys, the audience, see if you are able to spot the value trap. And the results, based on just the comments, are kind of mixed. So there are a couple voting for company A and a couple voting for company B. And I think one comment rightfully put it that value is not just based on numbers. Okay, so let me review the two companies. So if you see company A on your left, it's actually checked. It's a value trap.
Sorry. Hey, Zheng Feng, sorry. I think we can't see your slide. We only can see the first introduction. Now we see it.
Okay. Can you see the slide now?
Yes. Okay. Yep.
Yeah, sorry for the delay. Yeah, so hopefully everyone can see. So you have company A, which is the value trap. With your portfolio would have easily been half. And on the right side, you have ComfortDelGro, which has returned almost 40%. So I think the overall kind of takeaway here is that just based on financials alone, you can't really determine what is actually a value trap. So how do you actually spot a value trap? The straight answer is there is no definite method. Or if there is, I think all of us would be billionaires now, right? But I would say that there are generally some pointers that investors can take note to, I would say, avoid majority of the value trap. Okay, so 3 key points to look out for here. 1, re-rating catalyst. You want a stock to have some sort of near-term re-rating catalyst, be it earnings growth, acquisitions, or so on. So that's one.
Zheng Feng, sorry, you can move your slide to the next one. We are still seeing the poll results.
Right. So actually, it's in the next one, but I'm not sure why it's not showing up.
Oh, okay.
Showing up now?
No, we see. Yeah. Okay. Well, we see the value trap now.
Yeah. I think I'll keep it like that then.
I think you might be sharing. Are you sharing a slideshow? Because what we're seeing is it's not the slideshow. It's the.
Yeah,
outline.
I'm sharing the slideshow now.
Okay. So when you
Can you
move,
see
yeah, but we're seeing the one with your home with file and homes right at the top. So we're not
sorry,
seeing the slide show. We are seeing the.
what's happening again? Okay. Sorry for that technical issue. Is it working now?
Yeah, we can see, but you have to make sure you scroll to the next to the outline because we are seeing your desktop view.
Okay. Is it the slide view now?
Okay, and now it's the slide view, correct?
Okay, sure. Okay. Sorry for the technical issues. So second, business model. So you want to make sure that the business model is a sustainable one, right? And not going to be disrupted. And last would be cash generation. Because at the end of the day, you are not looking at a company that is reporting a bottom line figure of 50, 60 million. That must actually translate to cash to the company itself. Right. So next slide, if you can see the slide.
Yep.
So our value pick is in fact ComfortDelGro Group. So I think ComfortDelGro Group is well known to many of you out there. It's synonymous with taxis in Singapore. But what ComfortDelGro Group actually is that it is a diversified global transport operators with operations in many developed markets like Australia and UK. So if you look at overall valuation, as I previously pointed out, value is not just in the numbers. The stock has re-rated over 40%, nearly 40% over the past year. But nonetheless, we still continue to think that there is value to be had. Because if you look just based on historical, it is still trading below the historical average. So that's one. And we look at the three key points that I mentioned previously. Re-rating catalyst. So we do think that there is a very strong re-rating catalyst in the form of earnings growth. In fact, at DBS, we are projecting double-digit earning growth this year for the company. And one of the key growth drivers is that the company is now really exercising its balance sheet. So it is going on accretive acquisitions, right? Using their balance sheet to acquire companies at a reasonable valuation. And these companies are companies within their domain, in the transport domain. And these companies will actually help the overall growth in terms of long-term growth and, of course, improve the margins of the company as well. So catalyst check. And number two, we look at business model. So actually, if you look at business model-wise, if you probably look historically, maybe pre-COVID, 2017 or so, you can see that the stock price has actually suffered because of the inception of Uber, Grab, starting to come in and increase popularity. So at that time, I would say that the company is in fact a value trap because the overall industry, which is the taxi industry, was heavily disrupted back then. But now, fast forward to 2023, 2024, the company has in fact pivoted. So it has in fact pivoted towards the ride-hailing platform. So it has its own ride-hailing app called Zig. And now it is earning commissions and platform fees through that platform itself. And of course, also benefiting from increased ride-hailing riderships in Singapore itself. And if you look at the overall taxi fleet, which has been declining ever since the onset of Uber and Grab, that taxi fleet has in recent months been very, very stable. And last, if you look at the overall core business, 60-70% of the business in the public transport aspect, you can see that this is a very stable business and on a cost plus, they work on a cost plus model. So business model, stable and sustainable, check. And last, we look at cash generation. So ComfortDelGro Group is a very cash generative company. And one of the key metrics that I like to look at is, in fact, this operating cash flow to net income ratio. So anything above 1 is a positive. And ComfortDelGro has been generating over 2.3 times for that matrix for the last 5 years. So cash generation, check. So at DBS, we do think that ComfortDelGro Group is a good value buy, and we have a target price of 180. So even with the current run-up, we think that the ride is not over, and there is still 30% more upside to be had. Okay, so thank you for your time, and now I'll pass my time on to Casey. Thank you. Casey, please.
All right. Yeah, Casey, I know you got some slides that puts value investing into local context and more companies as well. So, Casey, over to you. You can share your slides with us.
Thanks, Tim and Zheng Feng. Can you see my slide?
Yeah, this looks good.
Okay, morning everyone. I'm Casey from CGS International. So today, I guess we are talking about value investing. And value stocks, by definition, I think broadly refers to stocks that are trading at a price that's lower than either its intrinsic value or book value. I think Zheng Feng has done his sharing on how to spot companies that are undervalued, whether it's relative to peers or relative to historical levels. So today I'll be speaking a bit more on companies that are trading below their book value, or in other words, price to book ratio below 1. So do you know that in Singapore, nearly 2/3 of SGX listed stocks currently trade below book value? Even for the stocks that are within our coverage, CGSI in Singapore, close to half of them trade below book value. When we dive deeper into this pool of stocks, about 60% of them are property stocks, which are property developers, REITs, etc. So I guess for those companies, it's kind of understandable why they're trading below book, given the high interest rate environment, and most of them do revalue their properties quite frequently. Another 30% of these stocks that are trading below 1x book, 30% of them are small cap stocks. And for quite a few under our coverage, we do see a good re-rating potential for some of them. We're discussing more of that in our report here, so feel free to head over to our virtual hall page to download the full report. So I definitely think that there are ways for the authorities to do more to revive interest in the Singapore stock market, taking learnings from Japan and Korea who have done so to drive a market-wide value creation. But I think for individual investors in Singapore, I would like to share some tips on how we can identify value picks from a bottom-up perspective. So here are 5 key pointers that I've summarized to help you recognize value stocks with re-rating catalysts. The first thing to look for is a clear focus on capital efficiency. Successful companies in this space will have plans in place to improve their valuations. So you would see some companies that set up specific ROE targets, which demonstrates the management's commitment to enhance shareholder value and maximizing the return on capital invested in business. I think companies that set out such targets send a strong signal to the market that it is dedicated to driving efficiency and improving its fundamentals worth. Another key indicator how the company is actively taking steps to improve its valuations is improving transparency. So of course, this can take various forms, including and I think currently a lot of small cap in Singapore lack that. Companies that are they're committed to providing investors better understanding should be able to re-rate more positively as they enhance transparency, because this builds trust and confidence amongst investors, allowing them to take more informed decisions about the company's prospects. So I will look out for companies that are regularly participating in IR events, which promotes interaction with investors, as well as companies that are actively enhancing analyst and media coverage to improve visibility and awareness. Third, we look at companies with clear shareholder-friendly policies. So this can include a consistent and growing dividend payout, which signals a confidence in business. I think share buyback programs, as well as insider buying, these are also indicators that management believe in the company's undervaluation. So companies that are launching such programs, I think this shows that they are focused on maximizing shareholder value and creating a compelling investment proposition. So if we look at SGX, I would say Keppel is one of the good case studies over the past years, whereby it has successfully re-rated from a below book value in the past due to its conglomerate structure with property exposure to above book value in recent years thanks to its corporate transformation efforts. So I think this chart shows very nicely its timeline of corporate execution, where Keppel repositioned its business from brown energy exposure, which includes offshore and marine, to green energy, which includes renewable solutions. Keppel has also transformed its real estate development business into an asset-light real estate manager. So over the past couple of years, you can see that Keppel's earnings have pivoted from lumpy order books and trading profits into now mostly recurring income, where it formed 80% of its last year's net profit. Among small cap stocks trading below 1x price to book under our coverage, we recommend Singpost, Centurion, and Hong Leong Asia as value picks with potential to drive valuation re-rating in the coming years via strategic transformation, capital recycling, or other corporate actions. So aside from their undemanding valuations, we also forecast all three stocks to see earnings growth over the next 2 years, which should help to cap downside risk. Since our report publication on the 8th of May, the three stocks have returned an average of 16% as of Friday. I'll just quickly go through the picks. For Singpost, our excitement lies in its 3-year transformation plan to dispose of non-core assets and transform the company into an international logistics player. So in March 2024, the company has announced 5 strategic trusts to drive growth and unlock value. And we estimate that there is almost 2.5 billion worth of assets under Singpost, which is ripe for value unlocking, either through a complete disposal or valuation realization through equity fundraising or even IPO. Earnings growth this year is also going to be expected to be strong in double-digit year-on-year, with consolidation of Borders Express, which they acquired earlier this year. I think share price recently saw some pullback, mainly due to the stake sale in Alibaba. So this provides good entry into the stock. For Hong Leong Asia, we believe it is an underappreciated proxy for the Singapore and Malaysian construction industry upcycle. If we exclude its stake in listed subsidiaries and associates, the remainder of the business is valued only at about 2x PE. And clearly, as you can see from the share price performance below, Hong Leong Asia has significantly underperformed its peers in the Singapore and Malaysia construction space. Of course, the company has looked to be a bit more sleepy in past years in terms of corporate actions, but we note that in recent months, Hong Leong Asia has turned a lot more active. Its subsidiary, China Yuchai, has already announced a share buyback program, as well as an equity incentive scheme, which hints at potential subsidiary spin-off in the coming years to unlock value. Centurion was the top performer amongst our 3 picks since our report publication in May, and share price is trading close to our target price now, so I think the investors can wait for a better entry point. Tailwinds remain. They continue to enjoy favorable industry dynamics and regulatory reforms to improve migrant worker housing standards. Also, it is actively exploring capital recycling, and we observe a handful of insider buying with substantial shareholder and CEO raising stakes in the past months. So I think from these 3 picks, you can see a common theme where we identified re-rating catalysts amongst them. So that's all for my sharing. And if you're interested, again, you can download the full report on our virtual hall page. Thank you, everyone. I'll hand the time back to Tim.
Yeah. All right. Hi. Thanks, Casey, so much. We have some time for a short Q&A. I see some questions as well. So if you guys got questions on your hand, feel free to put it on Pigeonhole, and we'll try to run through as many questions as we can in the next 10 minutes, which we have. But I will start first with my own question, right? So, Casey, your slide was quite interesting, right? I think on the earlier slides you shared that 70% of companies listed on SGX is actually trading below book value, if I'm not wrong, right? So I just want to follow that statistics up with a question of my own, which is, how accurate is it to think that small and mid-cap companies might tend to hold a little bit more value, or they might be a little bit undervalued? Because I feel like when I saw the stats you show, it seems to affirm that theory that, if you look at small and mid-caps, which I think on the Singapore Exchange, there's quite a lot of counters that fit into that criteria. It seems like it's easy for them to be undervalued. How accurate is it for me to think that way? And, is that a good thing or not necessarily a good thing?
Yeah, I definitely do think or agree with your view that the small caps tend to be a bit more undervalued compared to the larger caps. I think, first of all, a lot more small caps tend to have less investor attention / coverage. And in terms of institutional investors, due to the low liquidity in small cap stocks, they are unable to invest in the smaller cap stocks due to risk management constraints. So which leads to more small cap stocks being undervalued in terms of book value. So I think we do look out for small cap stocks. We do have very active coverage in small cap stocks in CGS International, but of course we do filter based on companies that shows good growth prospects, have shown willingness to engage with the market, etc. So I think we don't hunt for small cap stocks just purely because they are undervalued, but we need to be able to identify re-rating catalysts, to have a potential for better returns. If not, then there is always that potential risk of them being a value trap if there's no effort being put in to engage with shareholders.
Thanks, Casey. And the next question I have is for Zheng Feng. I think you were talking about Comfort Delgro, and my question is kind of linked to it because you mentioned about its performance during COVID and how it's performing now. My question is there or should investors think about a typical investment horizon or at least a minimum investment horizon for stocks that they're investing in from a value investing point of view? And how long do we typically have to wait before a stock that is undervalued becomes valued correctly?
Right. So I think the important, if any one of you is a Warren Buffett follower, you would know that his belief is that a good stock is a stock that you would hold for the lifetime. But I think that kind of changed in this current context now in this world, because things are ever changing, right? Like, just recently, as I pointed out, the advert of ride hailing kind of disrupted the whole taxi industry. So I think it's harder than ever, for sure, for investors to kind of look at value companies in particular. So what they have to do is, even if they do invest in value companies, they would have to maintain and kind of have a constant lookout. Now, the best platform is, please subscribe to our Insights Direct, where we give the latest update. But really to look out, make sure that the company's business model is sustainable in the long run. And when there is a disruption that's coming in, then maybe it's time to cut losses and sell at that point of time. Yeah. So that's how I view, in terms of time frame wise. Yeah.
Right. We have some questions, and we have quite a few questions. So I will just be pushing some of this question up, and one of it is on Comfort Delgro. So the person who is asking it is saying, on Comfort Delgro, I feel their overseas business have been dragging overall performance. Strong SGD has some blame because our currency have done well, but do you see operationally their overseas business outperforming their Singapore business, or how do you feel about their overseas business?
Right. So I mean, we have spoken to Comfort Delgro's management. I think the belief is, I think everyone knows that Singapore essentially is a relatively small market, and if they want growth, they will have to explore overseas. And indeed, some of their overseas business, especially the United Kingdom business, has not been doing very well. And one of the key reasons for that is, back in UK, how the structure work is that they work on inflation-based kind of cost-plus model. And in the recent years, as you know, UK has huge inflation. So that PEG has kind of took some time to come in. And this year would be the year where the additional inflation-linked kind of additional increment in terms of revenue will start coming in. So based on that, we think that this year would be when the UK business will start to recover very strongly and potentially even outperforming the Singapore business. Yeah.
All right. There is also a question on Singpost, so I'm just going to pass it to Casey. Question is, please share more about the 3-year plan of Singpost to transform its business. Maybe a minute or so. We'll just answer this. Yep, we can see your slide. You're mute though. You're mute.
Oh, sorry. Yeah.
Yep.
Just share back the slides. So I think these are some plans that Singpost is trying to do or to execute over the next 3 years in order to unlock value. So non-core divestments would include the likes of potential divestment of their Singpost Center, which is based in Paya Lebar. That alone, we value that at about 1.1 billion. There is, in terms of more immediate term potential corporate actions, a disposal of their freight forwarding business, which is Famous Holdings. And I do think that they are currently exploring options on equity financing of their Australian business. So I would value that Australian business right now at close to $1.2 billion. So these are some in terms of value unlocking steps that Singpost is doing. Of course, operationally, they have also carried out few adjustments here and there. You can see that they have successfully updated their postage rate domestically in Singapore, and currently is in talks with governments on how to make the local postal business more sustainable in the long run, given the ongoing structural disruption to the postal landscape. So I think there'll be more focus on e-commerce deliveries down the road in Singapore. And yeah, so these are some of the key highlights on Singpost in terms of their plans for the next 3 years.
Oh, okay, thanks. We have a couple of questions on property stocks that are trading below their book value. So I'm just going to read it out. Why do you think property stocks are mostly trading below book value, and what catalysts are needed to re-rate them back to book? The other one is more specific. Property stocks like CDI and Fraser Property are trading below half of their book value for a long time. Will they improve? So not sure if one of you want to take this question.
Yeah, I think property stocks. Yeah, I think property stocks in general, because some of them do revalue their investment properties on a frequent basis. So those in terms of balance sheet item, the property values are being reflected pretty frequently. But of course, investors will tend to give a discount given the property itself is illiquid and takes time to dispose if needed. So typically, property stocks, excluding the REITs, do trade at a discount to their realizable net asset value. In terms of CDL and Fraser's Property, of course, down the road, if we do see more corporate actions taken by the company itself to improve valuation, whether it's trying to go a bit more towards structuring properties into trusts or REITs, or to make their earning stream more recurring, then definitely these are things to look out for in terms of re-rating potential. In the near term, I think it's still going to be a bit more interest rate and macro driven.
All right, I just want to talk about some macro stuff. We have 2 more minutes, so just 2 quick questions. The first one is, I think someone is asking about Trump presidency. Will it affect SGX in general? I think this is in general, not necessarily just value companies. What are your thoughts, about elections? I think there have been a lot of elections, but I think the US election is clearly the best. So I think people are probably asking, is Trump being president good or bad for stocks in general, or SGX stocks in general?
Yeah, maybe I can share some of my 2 cents. So I guess what happened is, in the past, the previous Trump presidency, I would say that Singapore was the main beneficiary because of the US and China tension. So a lot of, I would say, wealth flow actually came into Singapore. And if there should be another Trump presidency, I would say that there would be more inflows of wealth into Singapore, which should, in theory, help to prop up the markets, especially the banks, for example, because all the wealth are coming in.
Okay. I think we don't have time, but I just want to ask one last question actually, because it just came in. I think the guy just asking, is oil and gas sector considered value play? Not necessary, or it depends?
Yeah, I think oil and gas, given or commodity stocks in general, given the high volatility in terms of the underlying commodity. So, for example, Keppel was mentioned as one of the examples of how its valuation can really very volatile in the past, when it was relying a lot more in the oil and gas field. How it has successfully transformed over the past years is by focusing more on items with or businesses with recurring income stream. So I would say in general, oil and gas as well as other commodity related players, because of the high earnings volatility, they tend to be a bit more undervalued in terms of price to book.
Okay. Thanks so much. I think we've come to the end of our time for this segment. Very good stuff. I think we ran through a lot of things in 30 minutes. So Nigel, I'll pass the time back to you.
Thank you, Chen Feng, Casey, and Timothy for that very insightful session. Next, we have our very first company spotlight with Jennifer Kang, Executive Director and Group CFO of HRNet Group. To watch the session, head over to the Program tab on SGGEM's website and click on the Watch Live button that is beside the session. If you encounter any issue, you can refer to the User Guide tab on the website for more information. We will see you there.